In today's video, we're covering the options out there for 401k rollovers, including the pros and cons of each. By the end of this video, you should better understand the options that you have if you were to leave your current job. As always, we gotta say this, we're providing a high-level overview of investment and tax topics, but this is not intended as a tax or financial advice video. Always remember to talk to a professional regarding your specific circumstances. A 401k rollover is when you move money from an old employer-sponsored plan, like a 401k, into an IRA or a new 401k plan. If you're close to retirement or changing jobs in general, you may need to understand the options as it can get really complicated. And with that, there are 5 main options that you can choose from when trying to figure out the best thing to do with your old 401k. Number 1, keep your old 401k with your former employer. That one's easy. Number 2, roll your old 401k into an IRA, individual retirement account. Number 3, roll your old 401k into a Roth IRA. Number 4, roll over your old 401k into a new employer's 401k plan. And then number 5, cash out your 401k, but beware of penalties and taxes. Now again, each option has different tax implications, so it's really important that you understand each before making a decision. Here are the main takeaways from this video. Number 1, if you want to consolidate your old 401ks to have more investment options, you'll likely want to roll over your old 401k into a traditional IRA. Keep watching to understand why this is. Second takeaway, if you want to take advantage of the backdoor Roth IRA, you may want to roll over the 401k into your new employer's 401k. We'll talk about why this is in a bit. Number 3, if you're in a low tax bracket this year and then want to take advantage of this, you may consider the 401k rollover into the Roth IRA and take the tax hit now. Okay, now let's cover each of these options in depth. First option, leave it in the ex-employer plan. If your ex-employer allows it, you can leave your old 401k money right where it is. This is by far the easiest option when you leave your employer, but that does not mean that it's the best option. So another way to put this is, the path of least resistance rarely leads to the best outcome. Let's talk about the positives to this, the pros. You should only consider this option if your ex-employer gives good investment options and then charges reasonable fees. If that's the case, then it might make sense for you to leave it there for the time being. With this approach, you don't miss out on time in the market because some rollovers can take weeks for the cash to get from your ex-employer plan to that new plan or IRA. If you value your time in the market and cannot live without being fully invested, you may want to choose this option. And while we're at it, if this is you, it might be time to remember that your 401k funds are meant for long-term purposes, 20, 30, 40, 50 years out. So a week or two in transit is probably not going to have a massive impact on your long-term plans in retirement. Now, the downsides of this plan are that many plans don't allow you to ask the plan administrator any questions after you leave. So you'll have to bank on not having any issues with the plan. It just could be harder to get communications regarding this plan. Often news is distributed through, company email or a Slack channel. So getting in touch with an administrator is just more difficult. Having access to information is extra important in the unlikely event that something goes south at your old workplace. Many ex-employer plans also charge higher fees for ex-employees. Make sure you check the fee schedule before deciding to leave the 401k funds right where they are. You also cannot make additional contributions once you leave. While compounding still has the same effect, whether you have one lump sum or many accounts spread out, many people like seeing a large balance in one account. And if this is you, consider consolidating your accounts instead of leaving it in that old 401k. Another noteworthy thing here is to consider that your former employer could actually decide to move your old 401k account without you. If your balance is between $1,000 and $5,000 and your former employer wants to close your old 401k account, they can, but are required to transfer the balance to an IRA in your name and then notify you in writing. For balances under $1,000, they can send you a check just like that. I don't know about you, but I don't like knowing that my money can be moved out at any time. So that one's a bit scary. Stop what you're doing. See that little subscribe button there? Click it really quickly so your financial life will just be way better going forward. Second option, a 401k rollover to a traditional IRA. You can move the 401k balance into a traditional IRA with any different brokerage. And this option is popular for many investors as it allows you to consolidate your retirement accounts into one place. Let's look at the advantages to this option. For most investors, The majority of your 401k funds are pre-tax, meaning that they were withheld from your paycheck before taxes. This is a great way to reduce your adjusted gross income and avoid income taxes in the year that they were withheld. In rolling over the funds to a traditional IRA, you're moving pre-tax funds into another pre-tax account, so you should not incur tax implications. Many traditional IRAs have more investment options than 401k plans as well. In all likelihood, in your old 401k, you have a choice of a few mutual funds or ETFs from one particular provider. However, with an IRA, you can invest just about anywhere, and you're likely to have more types of investments to choose from. At Wealthfront, we offer hundreds of investment choices, including ETFs, crypto exposure, and are going to offer much more in the future. Stay tuned on that one. Also, in a traditional IRA, you can also buy and sell investments anytime that you want. Most 401k plans limit the number of times per year that you can rebalance your portfolio or restrict you to certain times of the year. It depends on the type of brokerage that you use, but the IRS has no restrictions when it comes to the number of investments that you can have in an IRA. Rolling your 401k over into an IRA can also reduce the management and administrative fees that you've been paying, and those can eat away at your investment returns big time. The funds offered by the 401k plans might be more expensive than the norm for their asset class. Depends on the plan, but for a lot that they are. And on top of that, there is often an overall annual fee that the financial institution managing the 401k charges. You may not be able to avoid fees completely, but you'll have more choices and more control over how you'll invest, where you'll invest, and what you'll pay. Let's look at the downsides of this. If you keep the 401k funds in a 401k plan, whether it's your new or ex-employer, you might be able to borrow from that 401k. However, if you move the 401k to a traditional IRA, there are no loan provisions within IRAs. While many people don't envision needing to rely upon their 401k for lending purposes, it honestly could be a nice last-ditch safeguard in case something completely unexpected happens and you don't have funds anywhere else to use. You'd be surprised at how many people use this. Now, if you use a traditional human advisor, you may incur higher costs as well through management and advisory fees. All I'd suggest is that you instead focus on opening an IRA with a brokerage that offers the appropriate investment options with automated rebalancing for a low cost. If you're over the income limits to contribute to a Roth IRA and also want to take advantage of the backdoor Roth IRA, moving the 401k funds to a traditional IRA could limit the effectiveness of this strategy. This is due to a rule called the pro rata rule. Don't know what this is? All right, well, we'll link a video on this below in the description. But basically, at a really high level, if you want to do a backdoor Roth IRA, you may get taxed on other IRA funds, even if you're not converting them to a Roth IRA. Third option, 401k rollover to a Roth IRA. You can also roll over your 401k funds to a Roth IRA, whether they're pre-tax or post-tax. Assuming your 401k funds were held pre-tax, this strategy will incur tax implications, so just note that now. But why would this be an advantageous strategy for some? Well, if you're in a low tax bracket this year and want to take advantage of this, you could roll over the 401k to a Roth IRA and then take that tax hit now. You would be taxed on the full amount according to your marginal ordinary income tax bracket, but would not be penalized the additional 10% as this is considered a Roth conversion. If the 401k funds were post-tax, none of this would occur. Let's look at the advantages to this strategy. As with traditional IRAs, many Roth IRAs have just more investment options than your 401k plans would allow for. And the Roth IRA might give more control for the investing. Depending on the brokerage that you choose, traditional and Roth IRAs offer similar levels of control. And the same goes with fees. Now, we'll always talk about fees. Avoid these, especially in your IRAs. Rolling over your 401k into a Roth IRA could reduce the management and administrative fees that you'd been paying in your old 401k. And again, those can eat away your investment returns over time. If you have a Roth 401k, you can roll over your money to a Roth IRA without creating extra taxes. These funds were already taxed, so this is considered a like-kind transfer. While taking the tax hit could be advantageous for some, it can also be a negative for many people as well. If you're in a higher tax bracket this year, or just might have a large tax bill coming up, this strategy might not be the best option for you. For this reason, the tax hit is a pro and a con. Could be good, could be bad for some people. Fourth option, 401k rollover to that new employer 401k. A rollover to your new company's 401k plan may be the easiest option for you if you can't keep the funds in the old employer 401k. You'll keep all the money in one place with your new 401k, and that can be great for simplicity and consolidation purposes. Let's look at some of the advantages to this. If you plan on taking advantage of the backdoor Roth IRA, having all of your money in a 401k protects you from the pro rata rule. We'll link another video covering this, but this rule could really trip you up and limit the effectiveness of a backdoor Roth IRA, which is a useful strategy if you earn too much to contribute directly to that Roth IRA. Basically, if you do have other pre-tax funds already in any traditional IRA, you may incur taxes in converting your funds through a backdoor Roth IRA, even if you only convert the post-tax IRA funds. For tax purposes, the IRS treats all of your traditional IRAs as a single aggregate IRA, and this is sometimes referred to as the pro rata rule. When it comes to taxes, rolling over into the new employer 401k could also be advantageous because you won't incur any new taxes as long as you transfer to the same type of 401k at your new employer. For example, all pre-tax 401k funds need to stay pre-tax, and then all post-tax Roth 401k funds must stay post-tax as well. If your goal is tax minimization in the current tax year, this might make sense. Now, in looking at some of the downsides, your new plan may not have particularly attractive investment choices. For example, as many 401k plans just don't offer a wide range of investment choices. So many people just choose that target date fund just for simplicity purposes, right? And while this may make sense for many, could be fine, it doesn't give you the control that you may want over your retirement funds. Last option, a 401k distribution. You can also decide to take the cash and receive the 401k distribution. Taking an early withdrawal comes with a heavy cost though. If you take the money out of a 401k before retirement age of 59.5, the IRS will hit you with a 10% bonus penalty on top of the taxes that you'll already owe. In addition, you lose any potential appreciation over your working years, hitting your retirement nest egg really hard. Instead of taking this option, consider instead rolling your funds into your new 401k and then seeing if your new plan allows you to borrow against that money in the account. Most 401k plans allow for some kind of borrowing feature. You'll have to repay the funds along with that interest, but you may be able to avoid the taxes on the withdrawal, which is a win in itself. You may also see if you can take a hardship withdrawal after the funds get to that new 401k. This would potentially avoid the 10% bonus penalty. Thanks for watching. I'm Tony from Wealthfront. Check out this next video.